Everybody in the trucking industry, including myself, loves to complain about freight rates. And we definitely complain about fuel prices, especially right now. But what a lot of drivers don't realize is this: those two things are connected. And if you don't understand how they move together, you're playing the game blind. That's why in this episode, we're going to break down what actually drives freight rates, what controls fuel prices, and how smart owner-operators adjust so they don't just survive, they stay profitable.
I'm Chris. This is my 7th year owning a trucking company and hosting the Haulin Assets podcast. When I first started, I thought I knew trucking. Turns out I had no idea how much I would learn. Welcome back to Haulin Assets 2.0, where I take you through the good and the bad, the ups and the downs of being an owner-operator.
Yes, indeed. Welcome, everybody. Welcome to episode number 194. Let the countdown begin of the Haulin Assets podcast. This is an episode all about freight rates and fuel prices. I am Craig, your host. Over there, he is Chris. Chris, how's it going?
It's going pretty well. How you doing?
Not too bad. Not too bad. You know, I'm always, this is counterintuitive because I'm not much of a morning guy, but I like when we record in the mornings. It feels a little fresh.
It does.
All right. So today, like I said, we're talking fuel rates and freight rates and fuel prices. And frankly, there's a lot to get into. Before we do, though, I'll just remind everybody to go to HaulinAssetsLLC.com for full show notes. Go to MotorCarrierHQ.com for the tools, tips, and people you need to make the jump from employee driver to owner-operator, including, Chris, getting one of these sweet hats that I'm wearing, or this sweet shirt that I'm wearing, or that sweet shirt that you're wearing.
Look at you. You're hat and shirt. You're
I'm swagged out.
Matching.
Lastly, if you want to go the self-directed educational route, am I British? I can't remember anymore. You can go to HaulinAssetsAcademy.com. All right, Chris, let's dive in and get into today's subject. This is, like you said up top in your intro, about freight rates and fuel prices, something every trucker and every owner-operator, everybody loves to complain
All of us.
about. Well, maybe not the lowly employee drivers. Sometimes they might not care as much. Well, you should if you want a job. But especially once you make that leap into owner-operator, this becomes a really big deal. And it's like the weather, right? If you live, you deal with the weather. And if you drive truck, you deal with freight rates and fuel prices.
Yeah, that's exactly it. And the truth is the market doesn't care how you feel about the freight rates. The market is really driven by one simple factor, and it's just basic economics. It's supply and demand. And that's really what affects freight rates, not what the fuel price is today. It's supply and demand of trucks.
Yeah. Well, it's basic economics. I don't know. We don't have to get any more basic any more complex than basic economics. So what then do you want to get into, and maybe we can save this for later, what are the forces that are affecting the supply and demand going on right now? We could get into that, but where do you want to start with tackling this subject?
I think I want to kind of use a little bit of an analogy here. One of the things that I talk about, I've talked about it on the podcast before. I talk about it all the time with different people in my life, is you've really got to focus on things that you control. And freight rates and really fuel are like wind in the waves. Like they're going to come, you're going to have to navigate them. And what you can control, you can't control the winds, you can't control the waves, but you can control how you navigate them and how you ride them. And if you're smart, you're going to be able to ride them as smooth as possible. If you're not, you're going to get tipped over and you're going to get swamped. And so that's kind of really what I want to break down today, is how do you ride those waves smoothly? How do you understand or foresee what's happening in the market? Because the better you understand both the freight rate market and the fuel market, the better you're going to be able to adjust, and the better your business is going to handle those big waves and that heavy wind.
Yeah. Your analogy here was to boats, but as soon as you said tipped over, I went, no, Chris, the right analogy was a truck going on I-80 across Wyoming in the springtime.
Blown over. Yeah. That never happens.
No, oh my gosh. Yeah. It's, there must be no more littered freeway in the country than I-80 in Wyoming, just from all the debris that comes out of the back of these trucks that tip over. Right.
And really, for the most part, like the worst section of it is, Cheyenne to, Rawlins, Laramie area. Just, yeah, it's fun.
Yeah. All right. So Chris, let's get into some of the basic economics here. I guess the point of this is to illustrate or to demonstrate why, to some extent, or to, for the most part, it's futile to try to second guess or to, to predict what rates are going to be, what the market's going to do and all this. It almost is like wind and waves, because the simple economics here do act a bit like a force of nature, right? So I want to get down into why that is. But the thing is, I say this, but it's not random. Just like the weather isn't random, it's uncontrollable, but it's understandable to a certain extent, right? So can you give us a quick primer on supply and demand and some of the basics we want to know here?
It is understandable. And sometimes you can even see it coming. And so, being, always kind of keeping your eye to the future is super important here. So,
well, hang on. Let me back up though, because I'm curious, because you're talking like this is something you can control. But what you're saying is that you may be able to predict to a certain extent. Am I getting that right?
Exactly. You can foresee sometimes you can't. Sometimes, the U.S. invades Iran. Nobody knew that was going to happen, and it causes things to happen. You can't foresee that, but you can foresee seasonality. You can foresee the cycles to a certain extent. You're not going to be able to time them perfectly, but you can typically have a pretty good idea what's going to happen 2 or 3 years down the road, 6 months down the road, a year down the road, 2 years down the road.
I think so.
And the seasonal piece you can see.
Oh, I see. Okay. Sorry, I misunderstood. So you're saying you can't see it 3 years down the road?
You can sometimes. You can predict to a certain extent, because you've got these cycles, and we'll get a little bit more into the cycles further on down the road. But if you're in a really strong freight market and things are going really, really well, that's not going to last forever. And so you can plan and predict that at some point, it may be 6 months down the road, it may be 2 years down the road, but that cycle is going to change and it's going to bottom out. And you've got to plan for that and adjust for that. And that's what you can control, how you react to it and how you plan for it. So let's kind of take a step back and talk a little bit about what kind of causes this. In economics, and the freight market and trucking is no different, is all driven by supply and demand. And so let's talk about what exactly is supply and demand in the trucking industry. What causes those rates to go up? What causes those rates to go down? It all boils down to supply and demand. So supply in the trucking industry is the number of trucks that are out on the market. The number of trucks that are hauling freight. That's the supply. The demand is the amount of freight volume that needs to be hauled from one area to another. And so that's really, those are the two main driving forces in what causes freight rates to either go up or freight rates to go down. And the interesting thing about it is you've got a general economy that will generally raise and lower rates. But then you also have that same supply and demand factor working in specific regions or areas of the company or country at different times of the year. When produce is heavy in Florida, that's going to create a higher demand. And so it's going to cause freight rates to go up when that produce season is on, whether it's in California or Florida. That's going to happen.
Right. So based on freight demand, you can have regional spikes at a certain time, right? Onions in the summer here in Utah or whatever, right? But there will be, when you see macro spikes, it's because of something that's more nationwide right? So Christmas would be the ultimate example. holiday shopping means a lot more demand historically across the entire country, not just in Florida or, whatever, the warm southern states.
Or interest rates have hit an all-time low and more people are buying homes or building homes and construction's gone crazy. That's another thing that's kind of on a more macro, bigger level rather than the micro regional level. And
sorry, go ahead.
So you got to keep those two things in mind. The macro raises kind of the whole country, and micro more raises like specific regions, a city or, a state, a general area.
So with trends, economic trends like that affecting demand, there's some level of prediction we can do here. Now, unfortunately, it's not bulletproof, as we've talked about for the last few years. It's like, oh man, we're really excited for the holiday rush and all the boom, the economic boom that's going to come with that. And then sometimes it doesn't materialize to the level that we were hoping, right? Yeah. COVID threw a wrench and everything, et cetera, et cetera. So to a certain extent, you can predict that. But I want to talk about the other side of the ledger, which is the supply. I assume we're going to get into that, but I want to just really quickly ask about that part of it as well. Can you predict what the supply is or is going to be? Are there statistics out there? Here's how many trucks are on the road this month or last month or next month. Can you predict the supply?
You can to a certain extent. There are things that are called leading indicators. Trucking is typically a leading indicator for the general economy. Once things start to ship in a heavier volume, we typically know that the general economy is going to do better and increase. When on the reverse, when trucking demand goes down, that happens first. Shortly after that, you see the general economy go down. So I think a really good example that's probably easy for a lot of people to relate to and understanding this whole supply and demand cycle is if we look at COVID. March-ish of 2020, when COVID came on full bore and everything started shutting down, what happened? People stayed home. They couldn't travel. They couldn't do things. And what did that end up doing? That caused people to say, oh, hey, I still want to spend my money. I'm going to go buy goods and products. And so all of a sudden you've got this surge in demand because people are buying more and more products that need to be shipped. And so all of a sudden there's a huge demand for more trucks. So demand goes way up, freight rates go way up. And there's not, the supply of trucks. It takes time for that supply of trucks to increase to meet that demand. And for a year and a half, 2 years, it was sweet. It was really good. Freight rates were high because the demand was high and the supply of trucks were catching up. But then eventually that supply of trucks caught up and the rest of the world kind of started opening. You could travel again. People started spending more money on travel and things like that rather than as much on product. So all of a sudden now you've got a really high supply of trucks and the demand for freight is starting to go down. So roughly in March of 2022, the exact opposite happened. You had too big of a supply of trucks and the demand for freight was going down. And now all of a sudden freight rates over the next, really 3 or 4 years just started going down lower and lower and lower. And then it was really kind of 3 years. And then they kind of spent a year roughly kind of at or near that bottom. So in that cycle, right after COVID, you have a huge spike, like one of the best spikes ever in the trucking industry. And then after that, you have this huge dip that became like the worst dip that anybody can remember in the trucking industry. And that all happened because of supply and demand.
And so what I hear you saying then is, okay, the ship analogy really is the right one here because it is about waves. And we would love, I'm sure we would all love a situation where the market, the invisible hand, magically figured out what the right number of trucks is and things smoothed out and rates stayed the same and very predictable. And wouldn't that be nice? that ain't the world we live in. There's always going to be externalities. There's always churn that's causing those waves, the ups and the downs. And so this is calling to mind a couple of very early conversations. If people are new listeners, go back and listen to some of the original episodes, the way back, 1 through 20 or so. Because we talked about, is it the right time to start a trucking company? And this is reminding me of that, where it's like, are rates low right now? Still might be okay to start a company because rates are going to go up at some point. Are rates high right now? Great, start your company, enjoy it, but prepare, right? It also reminds me of your Joseph analogy, Joseph in Egypt, right? 7 years of plenty, 7 years of famine, and all that, right?
Yeah.
So expect the churn, expect the waves, and yeah, I guess not much more complex than that.
When it comes to starting a trucking company, I mean, you're going to hear all different opinions on this. What most people do is freight rates get really high and they start. But the problem with that is you don't know if that strong market's going to last 6 months or if it's going to last a year. But you know it's not going to last forever and it's going to come down. And a lot of the times when you start, when the rates are that high and you get accustomed to kind of that and you set up you set up your truck payments based on that. You set up a lot of things based on that high freight rate market. When the market drops out, it becomes really hard for those folks to survive. I actually think in most situations, it's better to do the exact opposite. We know we're in a low freight market right now. It's recovering, but it's not there all the way. If you can make your numbers work in this kind of a market and you can start and just, you're not going to be crazy profitable, making crazy amounts of money. But if you can do okay and be a little bit profitable, once that market turns again, your hook's in the water. You're there to take advantage of that strong freight market. And you've developed good habits to control your expenses and your costs in that tougher economy.
Okay. So this is good. And it's so tempting to chase this rabbit around the track and say, well, what are we going to do to control our costs? And I'm sure we'll talk a little bit about it, but I would refer people back to, I don't know the episode number. It just popped back into my head. It must have been somewhere around 130 to 150. The many mickles make a muckle.
Yeah.
Right. This was like at the low ebb or I guess it was the start of the low ebb for Haulin Assets and the rest of the industry as far as freight rates and profitability and all of that. And so that episode, people can go look it up and just use your search, mickle, muckle, whatever those words were, and listen to that episode because, Chris, that's where you dived into some of the specific little things that you guys were doing to try to mitigate the bad market rates, right?
Yep.
So excellent. But there is one aspect that we want to get into, and this kind of intersects with both of those ideas, the uncontrollable and the controllable, and that's fuel rates, fuel prices. Shall we dig into that a little bit and see how that interacts with what we've been talking about so far?
Yeah, let's do it. The thing that you really have to realize with fuel and fuel prices is the fuel market is truly a global market. A big chunk of the fuel, the crude oil, especially that gets refined across the world, it happens in either the Middle East or Russia. They're big producers of oil and crude. And so they control a lot of the supply that goes into the market and can, adjust supply. You hear the term OPEC. They're the oil producing countries of the Middle East. They all get together and kind of decide as a group how much oil they're going to produce so they can, to an extent, manipulate the market and make it so that those crude oil prices stay high enough for them to be profitable. And that can sometimes pinch other areas of the world because, if the U.S. producers, like we can make enough oil in the United States that we can be self-sufficient, but we're a capitalist society. And so if crude back in the Middle East And, for other countries like Europe and Africa and some of those countries need oil and they're paying higher prices for it. A lot of the U.S. manufacturers of crude, the crude producers are going to ship it over there because they get paid more for it. And so all of that, it affects, it's a world market.
Yeah, this gets into it's not something you can control, but it's something you can understand idea, right? And so, as you say, it's a world, what'd you call it? A world economy or a world market?
It's a world market.
This is it's a good that is affected everywhere. It's that old line from Obi-Wan Kenobi, Chris, that I'm sure you remember really well from The Phantom Menace. What happens to one will affect the other. You must understand this.
That's no truer words were ever said.
Anyway, so yeah, it matters, but for the purposes of our conversation, it doesn't matter that the single largest producer of petroleum in the world is the United States of America, because there's stuff going on in Russia and Ukraine right now. The Middle East is blowing up. Venezuela obviously has had some stuff going on, right? So these big oil producers, they all play in the same sandbox, so to speak.
They do. And that's what affects crude prices, which is one of the biggest factors of how much you're paying for fuel. But there's a lot of other factors, one of them being refining capacity. You take Utah, for example. We've got three kind of major refineries here in the Utah area that fuel or provide fuel for all of Utah, parts of Wyoming, Idaho, that's where all this refined product comes from. But refineries have to go offline every once in a while to, I don't know what they do, clean and make repairs, do maintenance, do all these things. When one of those refineries goes offline, especially if it's not planned and it's during a peak season, that's going to cause fuel prices to go way up. Sometimes in Utah, you'll see us below the national average. Sometimes you'll see us way above the national average. And that's because of that more local, refining capacity. When things happen there, the supply changes because a refinery goes offline.
Yeah, it's easy for us in Utah to say, hey, we've got these sweet refineries here, just like in Texas. It's like, shouldn't we have super low gas prices? No, it's a global commodity. That's the word I was looking for, commodity. Anyway, okay, so what then does this mean for the trucking company owner who's trying to control their costs, ride the economic waves? How do fuel prices play into this? You've talked before about using a fuel card and I'm trying to think of what other, being strategic about where and when you fill up, using that fuel card and trying to nickel and dime the system that way. But that doesn't seem like it would necessarily cover everything that I'd want to do as a trucking owner or understand about fuel prices. What else do I need to know about the issue?
This is kind of one of the big points I want to be able to make in this episode, is that freight rates and fuel prices truly move together. And here's why. Most contract freight, which is a big chunk of the freight that's hauled in the United States, is going to have a fuel surcharge built into that contract rate. So you take, for example, the contract rate. I'm just pulling numbers out of thin air.
Out of what, Chris? Out of what?
Out of thin air.
There you go.
Not something else. Not a part of my body. So let's say a contract rate is $2 a mile is what you're getting paid to do this. But there's a fuel charge built into it. And let's say at the time that this contract was signed, the national average of diesel was $3 a gallon. Well, when price if you built a fuel surcharge into that contract, if price goes up by, say, to $3.50 a gallon, then you get a charge, the client, a fuel surcharge that compensates you for that extra fuel expense that you're going to have. And almost all contract freight has that built in because it's unpredictable. You look at what's happening now with the Iran conflict, fuel prices went up over $1 a gallon in the course of a month. No trucking company is going to be able to remain profitable if they have to move freight at the exact same rate they were before prior to that charge. It's too big of an increase. Shippers and trucking companies realize that, and that's why they negotiate those into it. When you're operating more on the spot market, most of the shippers and brokers that post their loads on the spot market, a lot of those loads either have a contract, so there is fuel surcharging built into it, or it's freight that doesn't have a contract, and the shipper's not going to be able to haul or get it shipped if they're not compensating the trucking companies for that extra jump in the fuel price. So the spot market will adjust quickly to fuel prices. The contract market has those fuel surcharges built into it. So you need to use that knowledge and that understanding when you are negotiating your freight rates.
Okay, so this plays into your constant refrain of getting those contract loads. If you're trying to survive on the spot market alone after a year in business, then you're setting yourself up for potentially dicier situations, because then you're counting on hopefully having a good broker, or finding the right company that is that's playing to these economic realities and not trying to undercut with getting away with not compensating for those fuel differences, right? So getting those contracts and understanding how to build them, it's a pretty big deal. Chris, is this where I say visit motorcarrierhq.com, et cetera, et cetera? Okay. There's our commercial, Chris. It's
well done.
Yeah, thanks. I'm very convincing. I don't know if you knew that. Okay, cool. So what else can or should owner-operators know or do to stay profitable? Like in those, when the waves go down, you're in that trough and you're hoping to ride up in the future, but you got to survive now. What else can you do?
So one of the things that you've really got to realize is that although the freight rates and fuel prices move together, they don't move at the same speed. And so fuel prices can surge overnight, like we saw with, we're seeing right now with the US-Iran conflict. But the freight rates aren't going to move that fast. And so what that does is it kind of creates a gap, and you've got to keep that in mind. So typically when you pick up a load today and that fuel price surge today, even if you've got a adjustment for the fuel price, you're pumping that more expensive fuel today, but you're not going to receive that payment for that freight that you hauled for 30 days, maybe sometimes more. And so it kind of creates a gap, and you've got to be able to manage that cash flow during that gap until you start actually collecting the cash for the rates that you hauled. And that's one area where, like, if you're factoring your loads, that's going to help, because you're going to get paid more quickly and hopefully get some of that fuel surcharge money more quickly. But if you're not, especially if you're not, you've got to watch out for that gap and the cash flow pressures that it's going to cause your company.
Okay. All right. Any other fuel tips, tricks, ideas like strategies that people can implement to ride the market better? And I'm thinking more specifically, like, hey, can you do anything to your truck? Can you manage your fuel economy in such a way? I don't know if that's too big a subject to get into. It's
not. No, those are all things that you need to do. Maybe you're accustomed to driving your truck 70 miles an hour down the road. If you're running into this fuel pricing challenge, one of the ways that you can compensate for that is to drive at 65, or even 60. 62, 63, that's where most of the big fleets kind of feel like they really optimize that fuel expense. And so you may decide for a period of time, financially, it makes more sense that I've got to watch my fuel costs. I'm going to drive a little bit slower so that I get better fuel economy on my truck. The other thing you've really got to pay attention to, I harp on this all the time, you've got to know your cost per mile. And in this kind of a situation, you need to be reevaluating what your variable cost per mile is, maybe even on a weekly basis. If you don't know what your cost per mile for the fuel that you spend is, you're shooting yourself in the foot. And this is, again, it's one of those areas where you're kind of playing the game blind. I can tell you, for example, with Haulin assets, when fuel goes up by 50 cents a gallon, that's going to automatically cost us 7.5 cents more a mile for every mile that we operate. And if you don't understand it to that level, you're going to just hurt yourself, and it's not going to help you navigate those rough waters very smoothly.
And this gets to kind of the idea behind this show in the first place. So let me ask you a question, Chris. You've worked with truckers and trucking companies for a long time. Would you have been able to understand that in the kind of granular detail that you just described, the cost per mile, 7.5 cents per mile that it's going to cost for every 50 cents? Would you have understood that before you started hauling assets?
No, I wouldn't. And even to be honest with you, the first couple of years of running hauling assets, I probably didn't. It's one of those things I've learned over time. And I hope others will learn it more quickly because they're listening to this podcast. And that will be super beneficial to you.
Like and subscribe and share, everybody.
There you go.
No, I was just going to say that is kind of the purpose of the show, is like these are things that you didn't even know, having worked in the industry for a long time, until you'd been on the road for a few years, and other people can learn from your experience. Yeah.
One thing I'll, a little bit of a tip here. You've got to understand some basic math with trucking to really be successful at it. When you understand that basic math, you're going to be more successful, because the truth of the matter is you cannot outwork bad math. If you don't understand what that cost per mile is, and you're going at rates that aren't going to help you cover that and help you stay profitable, you're going to kill your company.
Yeah. Okay. So know the math, know your cost per mile, be fuel efficient when and wherever possible, right? Especially during these turbulent times, shall we say. And then if I understand what you're saying, there are things like tracking your cost per mile and like, reworking your contracts and all these things where, let's take tracking cost per mile. That's something that you should be doing regularly, right? Let's say in normal times, you might be doing that on a monthly basis, readjusting those numbers. But if you wake up in the morning and open up your news app on your phone and it says the US and Israel just bombed Iran, that would be an indicator that as a trucker, you're going, well, that's interesting news in its own right. But it also means I need to up my cadence of tracking and understanding my company and my rates. Am I right there?
Yeah, that's absolutely right. And you need to be able to make those adjustments. It's making those adjustments that are going to make the difference. Whether it's driving more slowly, or you may realize that, for instance, if, we're based out of Utah right now, right? And maybe right now under or pre the Iran thing, I could get the rate I needed out of Utah to be able to make money and be profitable. But let's say the fuel costs go way up and the fuel costs don't justify the rate I'm getting in Utah. I may need to adjust my fleet a little bit and to a certain extent, operate out of a different area of the country where rates are better. And that's another one of those things that the freight market within the United States has, it's one big freight market at a macro level that is really driven by major economic factors. But then there are regions within the company, like we talked about, at a more micro level that can have their own little surges, and where supply and demand has made it so that the freight market is really strong in that area. And so you may need to adjust for a temporary period of time and really go chase those stronger markets so that you don't, practice those bad math practices and get freight that is at too low of a rate to really cover your expenses and be profitable.
This is the danger. I said I liked recording in the mornings, but neither of us are quite on top of our words yet today. So what I hear you saying then is don't don't get married to certain routes and regions. Be nimble, be willing to adjust when necessary. Right? Don't stick around in a bad market just because, hey, that's where I've always gone. And kind of along those lines, you can see some truckers saying, well, hey, if I just work harder, it'll be fine. If I just say, you know what, it's fine. No, I don't need to see my wife and kids. Or no, I don't need to have the days off. I'll just run more. And so you hustle your way through it, where what you could and should be doing is strategizing your way through it, right?
Yeah. One of the things that's really interesting with this too is when you're not covering your costs all the way because your freight market's bad, you're essentially kind of bleeding yourself out, right? And how quickly you bleed out can be different. If the freight that you're picking up is not even covering your variable costs, which is a very common thing to happen when fuel prices spike, working harder is actually going to make you bleed out even faster. If you're at least covering your variable costs in a little bit, working harder might help bridge that gap. But if you're already not covering those variable costs, you're just going to bleed out even faster by running harder.
Amazing. Well, if that ain't counterintuitive, I don't know what is, Chris. All right, so let's make it real, Chris, and let's do something that we used to not do, which is incorporate financials into a broader discussion. So you've got some financials from March of 2026 for me. We're recording this toward the end of April, which is usually when we have the previous month's numbers all in and ready to analyze. So we're going to take a hard right turn and talk about some financials and then bring it back to the subject at hand, right?
Yep.
All right. So Chris, how was March?
Overall, all things considered, especially considering what's happened with fuel, March actually was a pretty good month in comparison with what's really happened the last 4 years. We ran 109,294 miles, which is a good number of miles. Mm-hmm. 10 trucks running. I'll take that. That's pretty good.
Okay. So that's the total number of miles then, for a total revenue of how much?
Total revenue was $279,827.06, that's a really strong revenue number.
Okay. Yeah. Call it 280. That must mean that the rate per mile was pretty decent. Give us, before you tell us what the number is, give us a little context. We've been talking about how tough the last few years post-COVID have been. We've been seeing rates anywhere from $1.80 up to $2.05 kind of on average for the last few years, right?
Yeah.
So what does that make the rate per mile in March of 2026?
So the rate per mile was $2.56 a mile.
There you go.
Really good. Last month in February, it was $2.48. Again, really good. And I will tell you that increase in the freight rate, I'll guarantee you, was 100% because of fuel prices.
Really? So this is that what you were talking about, the fuel surcharges, yeah, and all of that, of making adjustments for that.
Okay. And those didn't really start to come into factor until, I would even say, maybe middle of the month. I wouldn't be too surprised if in April we see that rate per mile even higher, because you'll have a little bit bigger of an impact in those fuel surcharges.
Okay. So that means that you said about 280,000 if we're rounding up, because you like to deal in dollars and cents. I like just dollars. So about 280,000 in revenue. A significant chunk of that was because the market was correcting for the fuel price increase.
Yeah.
Right? Okay. Interesting. All right. So where does that leave us then in terms of net profit?
So net profit was $32,135.22. So a respectable net profit, especially if you look at over the last 4 years, that's still one of our better months. But it's roughly a break-even cash flow wise. So not a whole lot of extra money to pay off extra debt or anything like that. But enough money to essentially cover all the expenses, cover the fuel payments. So all things considered, a pretty decent month.
So, okay. So connecting it back to what we've been talking about with freight rates and fuel prices, the numbers that you're looking at are pretty exciting. As far as, hey, the rates are going up, the profitability is going up, or at least the revenue is going up. Like, that's all great. But how much does that matter, Chris? If a lot of that is just going toward increased fuel prices, are you saying that's all built in and this is generating more profit? Or, how do these things intersect?
That's a really great question.
It's a really poorly worded question. Good luck.
Let's kind of go into the specifics. We'll use fuel as the example with this. I'm trying to pull up, I should have had our exact fuel number for February. So February, basically $63,000 is what we spent in fuel in February. Guess what we spent in March in fuel?
The increase was pretty nuts, right? So it's got to be approaching 100K?
Approaching 89,000.
89.
So
okay.
Putting math into it, it was basically a $27,000 difference in fuel from one month to the next. A fleet of our size, I have never seen anything even close to that. I'm trying to think. I don't think I've seen anything more than a $10,000 increase in a single month. So absolutely crazy.
So did that help or hurt when it comes to cash flow for the company? Because like I said, it sounds like, hey, we got all this revenue, the increased rates and all that, but you're saying, hey, we paid 27 grand more in fuel. So where does that leave Haulin assets?
It definitely hurt. I mean, if you look at the roughly 8 cents a mile more in revenue that we got, that would account for about $7,500 $8,000 in additional revenue that we brought in. That doesn't come anywhere close to offsetting the roughly $27,000 in additional fuel expense. So really that boils down to our net profit was probably affected by $19,000-ish lower because of the increase in fuel.
Wow. So, okay. But you wouldn't have, it's so complex. It's so simple and yet so complex, because if you hadn't seen the increase in fuel rates, then you wouldn't have seen the increase in the market rates. So, and oh gosh, it's all.
But all things said, like, it would have been better to not have the fuel costs go up that much. I mean, everything else, we probably would have seen closer to $50,000 in net income rather than $32,000 in net income.
Yeah. So how did that affect things in day-to-day terms for Haulin assets? What adjustments did you guys have to make? How did that look?
We, especially early in the month, had to be really careful with our cash flow. Kind of timing when we were making payments on things so that we could manage that increase in fuel. I mean, I remember the first week that we really saw that increase. It was our fuel bill that we pay on a weekly basis was $6,000 more. So you got to make sure there's enough money in the checking account when that payment hits. And that may mean that you're slowing down the payments a little bit more on some of your other vendors or suppliers or truck payments or something else, just to kind of offset that and work through. Luckily, we were able to manage that pretty well. But it's still, you got to think it through and you got to be careful. You got to be watching what's going on, paying attention.
How much pressure can you put on your clients and customers? It's saying, hey, look, this was the number last week. This is the number this week. Here's why we have to increase the rates. Do people respond to that, or is it tough to do? They
do. We haven't had to do this yet, but one thing that a lot of financial companies, like if they're financing trucks and trailer payments, if you call them up and say, hey, fuel's hit me really hard, my cash flow is really hard, can I take a pause on on making my truck payment or making my trailer payment. Most financial companies understand that and will give you a 1 month up to typically 90 days without much trouble. Well, they'll say, hey, we'll let you pause it. They're still going to continue to charge you interest. That interest is going to get tacked on to the loan balance. But they'll let you miss payments for a certain period of time without really affecting your credit, without affecting those things. Like most finance companies are understanding and will do that.
Interesting. Okay.
The other thing, like, for instance, with our, some of the other bills that we pay more on a 30-day basis that aren't due right when the work's completed, the company we buy our tires from, some of the, companies that do some of our maintenance, we can kind of push those off. Instead of paying them at 30 days, we paid them at 45 days, which, I don't love to do, but typically nobody's going to squawk too terribly loud when we pay at 45 days instead of 30. And in all honesty, a lot of people don't pay us for 45 days or sometimes even 60 days. So I don't feel super bad about doing that, but I don't love to do it. I want to be the guy that pays in 10 days so that, the people that are doing work with me want to work for me because they know, hey, he's going to pay quick.
Right. Okay. Chris, any final thoughts? We've gone long again. This is becoming a pattern for us at this point. But this is important stuff. And frankly, although it's hard to wrap my head around, I think it's pretty interesting stuff. Any other thoughts that you want to get into, whether it's about March financials or the overall topics that we've been discussing?
Just pay attention to everything that's going on right now. We had a few months of really good relief in, fuel prices were still relatively low. Freight rates were going up. Cash flow was super strong. And that changed kind of almost overnight. I don't think we're going to go back into the market we were at 6 months ago. I would much rather be, even with the increase in fuel prices, where we are today than where we were 6 months ago or a year ago. But you've got to be cognizant that things are changing. Keep your eye on things, watch what's going on, and be able to react. And that's the difference between flying by the seat of your pants and actually running a business smartly.
Hear, hear. All right. Well, then I will just wrap up by saying a few quick words. HaulinAssetsLLC.com, MotorCarrierHQ.com, and HaulinAssetsAcademy.com. Lastly, we joked about this a little bit during the episode, but if you appreciate what we're doing here, if you like the show, if it makes you think a little bit more about how you're running your company and gives you a little something to listen to while you're on the road, tell your friends. Let them know that there's this show. Make sure that they know that they can listen as well. Jump into your Reddit forums and your Facebook groups and let them know about the show. We would greatly appreciate that word of mouth. And other than that, Chris, I think we're good for today.
Okay.
See you next time.
See you then.